Listen, if you're holding gold for retirement right now, what I'm about to show you could completely change how you think about your financial security. And I'm not talking about some vague market prediction or fear-mongering. I'm talking about specific documented changes happening in the gold market right now that most retirees have absolutely no idea about. See, here's what nobody's telling you. While everyone's been focused on stock market volatility and inflation headlines, something fundamental has shifted in how gold actually works as a retirement asset. And if you don't understand this shift, you could be sitting on what you think is a safe haven that's actually exposing you to risks you never signed up for. Let me paint you a picture. It's 2008. The financial system is collapsing. Lehman Brothers just went under. Bear Stearns is gone. And retirees who thought they were safe in traditional portfolios are watching their nest eggs evaporate by 30, 40, even 50%. But there's this one group of people who aren't panicking. They're the ones who moved into gold years earlier. While the S&P 500 is cratering, gold is climbing from $700 to over $1,000. Those retirees, they're sleeping at night. Fast forward to today. Gold just hit record highs above $2,700 an ounce. Sounds great, right? Your retirement gold holdings are worth more than ever. But here's where it gets interesting, and this is what you need to understand. The gold market you're participating in today is fundamentally different from the one that protected those retirees in 2008. And these differences create risks that most people holding gold for retirement don't even know exist. Let me show you what I mean. Right now, there are essentially two gold markets operating simultaneously. There's the physical gold market, where actual metal changes hands, bars in vaults, coins in safes, real, tangible gold. Then there's the paper gold market, where contracts and certificates represent gold, but no actual metal moves. And here's the critical part. The paper market is roughly 100 times larger than the physical market. Think about that for a second. For every ounce of actual gold that exists, there are about 100 paper claims on gold floating around in the financial system. It's like a game of musical chairs where there are 100 people, but only one chair. As long as everyone believes they can sit down when the music stops, everything's fine. But what happens when people start demanding their actual chair? We're starting to see the answer to that question play out right now. And it's creating a risk for retirement gold holders that most financial advisors won't tell you about because, frankly, most of them don't understand it themselves. Here's a real example that happened just last year. A major European bank, one of the largest gold dealers in the world, had clients who owned gold certificates. Paper claims on gold held in the bank's vaults. These weren't small-time investors. We're talking about wealthy individuals and institutions with millions in gold holdings. One day, several of these clients decided they wanted to convert their paper gold into physical metal. They wanted delivery. The bank's response? Delays. Excuses. There's a processing backlog. The vaults are being reorganized. It'll take several months. Some clients waited over a year to get their gold. Others eventually gave up and sold their certificates back to the bank at whatever price the bank offered. They never got their metal. Now, was this bank running a scam? Probably not. More likely, they were caught in the same trap that's affecting the entire gold market right now. They had sold more paper claims on gold than they actually had physical gold to back them up. It's legal. It's standard practice. And it's creating a ticking time bomb for anyone who thinks they own gold, but actually owns a promise to deliver gold. Here's where this gets personal for retirees. Let's say you bought gold through a major brokerage or a gold ETF. You see the gold price on your statement. You feel secure knowing you're diversified into precious metals. But do you actually own gold? Or do you own a financial instrument that's supposed to track the gold price? Most gold ETFs, the ones regular investors buy through their brokerage accounts, don't give you any claim to physical metal. You can't call them up and say, "Hey, I'd like to take delivery of my gold bars." They'll tell you that's not how it works. You own shares in a fund that owns gold. Or more accurately, you own shares in a fund that owns contracts that represent gold. See how many layers of separation there are between you and actual metal? Now, in normal times, this doesn't matter. The ETF tracks the gold price. You can sell your shares anytime. Everything works fine. But we're not talking about normal times. We're talking about the exact scenarios where retirees buy gold in the first place. Financial crisis, currency collapse, banking system stress, the moments when you actually need gold to work as a safe haven. And here's the brutal truth. In those moments, paper gold and physical gold can trade at wildly different prices. We saw this happen in March 2020 when COVID hit. For a brief period, the spread between paper gold futures and physical gold delivery prices exploded to over $100 an ounce. If you owned paper gold, you were stuck at the lower price. If you owned physical gold, you could sell at a massive premium. Same asset, completely different outcomes. Let me tell you about Margaret. She's 72, retired school teacher from Ohio. Smart woman, did everything right. Saved diligently, diversified her portfolio, and about 10 years ago she moved 20% of her retirement savings into gold. She bought shares in a popular gold ETF through her brokerage account. Felt great about it. Gold was her insurance policy. Last year, Margaret started getting nervous about the banking system. She'd been reading about bank failures, currency problems, all the stuff that makes retirees lose sleep. She decided she wanted to actually hold some physical gold. Not all of it, just enough to feel secure. So she called her broker and asked how to convert her ETF shares into physical metal. The broker was confused. "Ma'am, that's not really how it works." He explained that she'd have to sell her ETF shares, take the cash, then find a dealer to buy physical gold from. Okay, fine. She could do that. But then he mentioned the premiums. Physical gold coins were trading at 8 to 12% above the spot price. Bars were a bit cheaper, but still carried premiums. Then there were dealer fees, shipping, insurance, storage if she didn't want to keep it at home. Margaret did the math. To convert her paper gold into physical gold would cost her about $15,000 in premiums and fees. $15,000 just to get the actual metal she thought she already owned. She was furious. But more than that, she was scared. Because she realized that in a real crisis, when she actually needed that gold, those premiums could be even higher, or physical gold might not be available at any price. This is the risk nobody talks about. It's not that gold won't hold its value. It's that the gold you think you own might not be accessible when you need it most. And for retirees, that's a catastrophic problem. You don't have time to recover from a mistake like that. You don't have decades of earning power ahead of you to rebuild. You need your safe haven assets to actually be safe havens. Now, let me show you what's making this situation even more dangerous right now. Central banks around the world are buying physical gold at the fastest pace in decades. The People's Bank of China has been adding to its gold reserves every single month for over a year. Russia, Turkey, India, Poland, Singapore, all accumulating physical metal. In 2023 alone, central banks bought over 1,000 tons of gold. That's the highest level since 1950. Why does this matter? Because central banks don't buy paper gold. They don't buy ETFs or futures contracts. They demand physical delivery, actual bars in their vaults. And they're pulling that physical gold out of the available supply. Every ton that goes into a central bank vault is a ton that's not available for regular investors who might want to convert their paper claims into metal. At the same time, gold mining production has basically flatlined. We're not finding major new gold deposits. The easy gold has been mined. New projects are deeper, more expensive, more complex. Meanwhile, industrial demand for gold is increasing. Electronics, medical devices, aerospace. Gold isn't just a monetary metal anymore. It's a critical industrial commodity. So you've got supply that's stagnant or declining, industrial demand that's rising, and central banks hoovering up physical metal by the ton. What happens to the price of physical gold versus paper gold in that environment? The spread widens. The premium for actual metal goes up. And if you're holding paper gold in your retirement account, you're on the wrong side of that equation. Here's another angle most people miss. The COMEX, the major commodities exchange where gold futures trade, has specific rules about delivery. If you own a futures contract and you want physical gold, you can request delivery. But there are limits. There are timing requirements. There are approved warehouses. And most importantly, there's a limited amount of gold actually available for delivery at any given time. Right now, the COMEX has about 20 million ounces of gold in its registered vaults available for delivery. Sounds like a lot, right? But there are over 60 million ounces worth of open futures contracts. That's a 3-to-1 ratio. Again, musical chairs. As long as most contract holders are just trading paper and not demanding delivery, the system works. But if even a fraction of those contract holders decided they wanted their metal, the COMEX couldn't deliver. What would happen in that scenario? Probably not a complete collapse. The exchange would likely change the rules. They'd offer cash settlement instead of physical delivery. They'd raise margin requirements to discourage delivery requests. They'd do whatever it takes to keep the paper market functioning. But if you're a retiree holding gold futures or ETFs that are based on futures, you'd be stuck accepting whatever solution the exchange imposed. You wouldn't have a choice. Now, I want to be clear about something. I'm not saying paper gold is worthless. I'm not saying ETFs are a scam. In normal market conditions, they work fine. They're liquid, they're convenient, they track the gold price reasonably well. But retirement planning isn't about normal conditions. It's about worst-case scenarios. It's about making sure your safe haven assets actually work when everything else is falling apart. And here's what the data shows. In every major financial crisis over the past 50 years, physical gold has outperformed paper gold, not by a little, by a lot. In 1980, when gold hit its inflation-adjusted peak, physical coins and bars were trading at massive premiums over spot prices. In 2008, during the financial crisis, the same thing happened. In 2020, during the COVID panic, it happened again. The pattern is clear. When fear spikes, people want real metal, not paper promises. So what's a retiree supposed to do? You can't just ignore gold. It's still one of the best hedges against currency debasement and financial system risk. But you need to own it in a way that actually protects you. Quick aside here, and this is important. If you're sitting on $100,000 or more in retirement accounts, there's a structure called a gold IRA that lets you hold physical gold inside your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how this works, what the rules are, and how to set it up properly. It's in the description below. Worth checking out if you're serious about protecting your retirement with real metal instead of paper promises. Anyway, back to the bigger picture. Let's talk about what's coming next, because this is where the retirement risk really crystallizes. We're heading into a period where the gap between paper gold and physical gold is likely to widen dramatically. And if you're not positioned correctly, you could watch your retirement security evaporate even as the gold price is rising. Here's why. The Federal Reserve is trapped. They've got inflation that won't go away, an economy that's slowing down, and a government that's running trillion-dollar deficits. They can't raise rates high enough to kill inflation without crashing the economy. They can't cut rates without reigniting inflation. They're stuck. And the only way out is to devalue the currency. Print more money. Inflate away the debt. Every retiree knows this playbook. It's what destroyed savings in the 1970s. It's what's been slowly eroding purchasing power for the past decade. And it's why smart people own gold. But here's the twist. This time the devaluation isn't going to be slow and steady. It's going to be sharp and sudden, because the world is losing faith in the dollar as a reserve currency. Look at what's happening internationally. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternatives to the dollar for international trade. Saudi Arabia is accepting yuan for oil sales. China and Russia are settling trade in their own currencies. The petrodollar system that supported American financial dominance for 50 years is cracking. When that system breaks, and it's a question of when, not if, there's going to be a massive rush into gold. Not paper gold, physical gold. Because in a currency crisis, nobody trusts financial instruments. They want tangible assets. And the retirees who own paper gold are going to discover that their insurance policy doesn't actually pay out. Let me give you a historical parallel. In 1971, when Nixon closed the gold window and ended dollar convertibility, there was a brief period where you could still exchange dollars for gold at the official rate of $35 an ounce, but only if you were a foreign central bank. Regular Americans couldn't do it. And within a few years, gold was trading at over $200 an ounce in the free market. The people who had paper claims on gold at the old price got destroyed. The people who owned physical metal made fortunes. We're setting up for a similar situation today. The official gold price, the paper price you see on financial websites, is being held down by massive futures selling and ETF creation. But the physical market is getting tighter and tighter. Premiums are rising. Delivery times are extending. Smart money is quietly accumulating metal while it's still available. And here's the thing that should terrify retirees. When the break comes, when paper and physical gold decouple, it's going to happen fast. You won't have time to react. One day, you'll wake up and physical gold will be trading at a 30 or 40% premium over paper gold. Your ETF will show one price. Dealers will be charging a completely different price for actual metal. And if you try to convert your paper gold to physical gold at that point, you'll take a massive haircut. I've seen this movie before. I watched it play out in the silver market in 2020 and 2021. Paper silver was trading at $25 an ounce. Physical silver coins were selling for $35 to $40. The spread was insane, and it lasted for months. People who owned paper silver couldn't access the real gains. People who owned physical silver made out like bandits. Now, multiply that scenario by the size of the gold market and the stakes for retirees. We're not talking about a few percentage points of difference. We're talking about the potential for your retirement hedge to fail at the exact moment you need it most. That's not a risk. That's a catastrophe. Let me tell you about Robert. He's 68, retired engineer, very analytical guy. He'd been tracking the gold market for years. He owned gold through a major ETF, about $200,000 worth. He understood the paper versus physical issue, but he figured the ETF was close enough. It was convenient, liquid, and the price tracked gold reasonably well. Then last year, Robert started noticing something strange. The ETF's gold holdings, the actual metal the fund claimed to own, started declining even as the gold price was rising. He dug into the fund's reports and discovered they were selling physical gold and replacing it with futures contracts. Same gold exposure on paper, but less actual metal backing the shares. Robert got nervous. He called the fund company to ask about it. They gave him some technical explanation about optimizing their holdings and reducing storage costs. It sounded reasonable, but Robert's engineering brain saw the problem. The fund was becoming more leveraged, more dependent on the paper market, less backed by physical metal. He decided to get out. He sold his ETF shares and bought physical gold bars through a dealer. It cost him about $20,000 in premiums and fees to make the switch. His wife thought he was crazy. "We're losing $20,000 for no reason," she said. Robert's response? "We're paying $20,000 for insurance that our insurance actually works." 6 months later, there was a brief banking panic. A couple of regional banks failed. Gold spiked. And for about a week, physical gold was trading at a 15% premium over paper gold. Robert's bars were worth $30,000 more than his ETF shares would have been. He'd made back his conversion cost, and then some. More importantly, he could sleep at night knowing he owned real metal, not a financial instrument that might or might not deliver when he needed it. That's the decision every retiree holding gold needs to make right now. Are you willing to pay the premium for physical metal? Are you willing to deal with the storage and security issues? Are you willing to sacrifice some liquidity for the certainty of owning real assets? Because here's what I can tell you with absolute confidence. The next financial crisis, whenever it comes, is going to expose the weakness in the paper gold market. It's going to create a massive divergence between paper prices and physical prices, and the retirees who are on the wrong side of that divide are going to suffer losses they can't recover from. Now, let's talk about the mechanics of how this actually plays out, because understanding the process helps you see why this risk is so serious. When you own a gold ETF, the fund is supposed to hold physical gold in vaults to back your shares, but they don't hold 1 ounce for every ounce of exposure. They use a combination of physical gold, futures contracts, and other derivatives to create the gold exposure. This works fine when the futures market and the physical market are trading at similar prices. The fund can arbitrage between the two markets, buying whichever is cheaper and selling whichever is more expensive. But when the markets diverge, when physical gold starts trading at a significant premium, the fund can't easily convert its futures contracts into physical metal. They're stuck. What happens then? The fund's net asset value, the official price of the shares, continues to track the paper gold price. But if you tried to redeem your shares for physical gold, which most ETFs don't even allow, you'd discover there's not enough metal to go around. You'd be forced to take cash settlement at the paper price, while physical gold is trading much higher. This isn't theoretical. It's happened in other commodity markets. It happened in oil during negative prices in 2020. It happened in natural gas during the European energy crisis. It happened in nickel on the London Metal Exchange when a short squeeze forced the exchange to cancel trades. When paper markets and physical markets diverge, the paper market holders get crushed. And for retirees, this is existential. You're not a hedge fund that can absorb a loss and move on. You're not a trader who can make it back on the next trade. You're someone who spent 40 years building a nest egg, and you need that nest egg to last for the rest of your life. You can't afford to have your safe haven assets fail. Here's another dimension to this that most people miss. The gold in ETF vaults isn't just sitting there waiting for you. It's being lent out. The funds lend gold to bullion banks, who use it for various trading strategies. This is how the funds generate extra returns to cover their expenses, but it also means that the gold backing your shares might not actually be in the vault. It might be out on loan, and you're relying on the borrower to return it. In normal times, this is fine. The borrowers are credit-worthy institutions. They return the gold as agreed. But in a crisis, when those institutions are under stress, do you really want to be relying on their ability to return borrowed gold? Do you want your retirement security dependent on the solvency of some bullion bank you've never heard of? This is the hidden leverage in the gold market. It's not just the futures contracts and the paper claims. It's the lending and rehypothecation of physical gold. The same bar of gold can be claimed by multiple parties. And when everyone tries to claim their gold at the same time, somebody's going to be left holding an empty bag. Let me paint you one more scenario, because I want you to really understand what's at stake here. Imagine it's 2 years from now. The economy has slipped into recession. The Fed has started cutting rates aggressively. Inflation is picking back up. The dollar is weakening against other currencies. And gold is rallying hard, up to $3,500 an ounce. You're feeling pretty good. Your gold holdings have increased in value by 30%. Your retirement account looks solid. But then you start hearing reports. Physical gold is hard to find. Dealers are sold out. Premiums are spiking. The U.S. Mint has suspended sales of gold eagles because they can't source enough blanks. And physical gold is trading at a 20% premium over the paper price. Your ETF shows gold at $3,500. But if you wanted to actually buy physical gold, you'd have to pay $4,200. That's a $700 spread. And suddenly you realize that your gold holdings aren't worth what you thought they were worth. You own paper gold at $3,500, but you can't convert it to physical gold without taking a massive loss. Now imagine that scenario gets worse. The government, facing a currency crisis, decides to implement capital controls. They restrict the movement of money out of financial institutions. They limit withdrawals. They freeze certain types of accounts. Your gold ETF is stuck in your brokerage account and you can't access it. Meanwhile, people who own physical gold can still transact. They can still protect their wealth. They have optionality that you don't have. This is the nightmare scenario for retirees. It's not that gold fails as a safe haven. It's that your form of gold ownership fails. The metal itself is doing exactly what it's supposed to do, protecting wealth and maintaining purchasing power. But you can't access that protection because you own a financial instrument instead of the actual asset. And here's the really insidious part. By the time you realize this is happening, it's too late to fix it. The premiums are too high. The physical metal is too scarce. The conversion costs are prohibitive. You're locked into your paper gold position, watching physical gold holders benefit from the very crisis you bought gold to protect against. This is why I'm so adamant about retirees understanding this risk right now, while there's still time to do something about it. The warning signs are all there. Central bank buying, tightening physical supply, rising premiums, increasing delivery times. The smart money is already moving. The question is whether you're going to move before the crowd figures it out. Because once the crowd figures it out, once regular investors start demanding physical delivery en masse, the system is going to break. The exchanges will change the rules. The ETFs will suspend redemptions. the dealers will run out of inventory, and you'll be stuck with whatever position you have at that moment. I've spent 30 years in financial markets. I've seen bubbles inflate and pop. I've seen currencies collapse. I've seen financial instruments that were supposed to be safe turn out to be worthless. And I can tell you with absolute certainty that the paper gold market is setting up for a reckoning. The leverage is too high. The physical backing is too thin. The divergence between paper and physical is too obvious. For retirees, this isn't about making money. It's about not losing money. It's about making sure that the assets you're counting on to protect you actually do protect you. And right now, if you're holding gold through ETFs or futures or any other paper instrument, you're taking a risk that you probably don't fully understand and definitely don't need to take. The solution isn't complicated. Own physical gold, real metal, bars or coins in your possession or in a secure vault that you control. Yes, it's less convenient. Yes, there are storage and security considerations. Yes, you'll pay premiums to acquire it. But those are small prices to pay for the certainty that your safe haven asset is actually safe. And if you're holding gold in a retirement account, make sure you understand exactly what you own. Is it physical metal? Is it an ETF? Is it a futures contract? What are the redemption terms? What happens in a crisis? These aren't academic questions. These are the questions that will determine whether your retirement security survives the next financial storm. The gold market is sending clear signals right now. Physical premiums are elevated. Central banks are accumulating. Supply is tight. The paper market is over-leveraged. These are all warning signs that the current structure is unstable. And when it breaks, it's going to break fast and hard.